Hey, happy weekend, everybody. What happened here? I just, hang on, let me change default scene. Yes, good. It's always a technical glitch. Well, good morning, everybody. Before we jump in, I just want to show you guys one thing real quick. I'm going to share my screen. And yeah, if you can see my screen, my chart here, there's a couple of things that are interesting to look at. One is the Bitcoin dominance fell down from that near 47 level. And this is a good sign. This means the alts are coming back. Also, look at the relative gains for Bitcoin. Bitcoin's up 1%, Ethereum's up 3%, and Solana's up nearly 5%. So again, the key thing I just want you to take away from everything here is the alts fall faster, they move up faster, all in terms of relative market cap. That's why we're in this. And that's a big part of what we're going to talk about today is network effects. But let's not waste any more time. Let's jump in. Thank you all for being here. And I'm well aware it's a rough time, but let's go. Math, money, and freedom. And none of this is financial advice. It's edutainment. So a couple of things I'm going to talk about today is really talk about the exponential times we live in, the opportunity, Metcalfe's law, and a couple of pieces of insight, because I know everybody's freaking out. But remember, we're back at levels or higher than levels we were 10 months ago. So first of all, a reminder, network effects are everything. It's a lot of what we look at here. Now, you need to have conviction in the top names that have network effects. Trust me, this will all make sense in a few minutes. And the majority of returns are generated by a small number of assets in anybody's portfolio. And think of the power law curve. It was a great piece from Real Vision that talked about this, the importance of holding on to winners, not layering out of them too early. And it's also critical to weather substantial volatility because risk-adjusted return is typically best with the highest volatility assets. And remember, this whole cryptoverse, this is why I'm fascinated by it, it's compounding at 185% per year. Okay? That is huge. That's bigger than the internet. And this is from Raoul Pal himself. Exponential cycle, faster than the internet. The white line is the internet growth. When we had 1 billion users, that was considered, 100. Let me get this right. Test my eyes. Total internet users year 1 million users. Yes, for the internet, that was back in 1992. For crypto, that was in 2016. But look, the orange line is much higher than the internet line, and it's expected we'll have well over 1 billion users in a very short amount of time. But the pricing of the assets that are going to be part of this revolution are not even taken into account. This is why I want to hammer this point home. Now, network effects, why are they critical? Because cost increases linearly, but as the number of users join the network, the value increases exponentially. Again, this is the simplest handwritten chart you will ever see, but it is absolutely critical to understanding why we are in this. Okay? Next thing, a little bit of a mea culpa. I did, because I'm so obsessed with Metcalfe's law and activity on chains and daily active users, I pulled data and I shared all my sources for all the things, but there was one data source called Into the Block. I have a premium subscription. The data that they had for daily active users for Phantom was off. This is the corrected amount. And again, we had to pull much data from many different sources. We corroborated when we could, but the Phantom data was off. So apologies for that. This now is up to date. And again, what is critical though, even though the Into the Block data was off based on my new source, which is Nansen, the relative trend is the same. And that's what we look for. We look for trends. Which chains are growing fast, which chains are being adopted, which chains are wilting. That is the message to go for. And speaking of the importance of daily active users by chain, you can see here these two, Phantom and Avalanche understand it. A subway underground train in New York City is plastered with Avalanche ads because Amin understands the importance of users. Same with Phantom sponsoring 4-in-1 cars. That is why if a chain does not have users, it's a ghost chain. These chains realize that, therefore they advertise to bring more people into their chain. Notice, I've always spoken about this as well. Good stuff doesn't have to advertise itself. You don't see Tesla ads or Solana ads or anything else, but I'm not going to leave that here. I'm just leave that here. I'm not going to get political. Now, Tim Draper He's a guy who understands network effects better than anybody. All of his best investments, top VC in the world, all of his best investments had huge returns because of network effects. But he had this beautiful take. While he still believes we could hit a Bitcoin of 250,000 by year end or in 2023, I know that's a bit of hopium, not spreading hopium. But what if you think about what he said, it was super interesting. And he, again, was kind of pounding his fist on the table. I think it was Wolf of Wall Street's podcast he was on. And he said he doesn't know when it's going to happen, but he knows it's going to happen. He believes women are going to start using Bitcoin at a more accelerated rate. So basically, recently, it was 1 in 14 Bitcoin holders were female. Now it's like 1 in 6 or 1 in 8. And eventually it's going to be 50-50 because planet Earth is made up of 55% females. And they typically also control the purse strings. They control all finances in the household. If you're ever in Asia, everybody that runs a business over there is predominantly female. And they control the books and everything else. So we'll see. But his point was, because I can't remember the exact numbers, but women control about 80% of retail spending. Once they start adopting Bitcoin, and once retailers start realizing that they can save 2.5-3% on credit card charges, boom, it's game over. And that network effect will drive Bitcoin price to $250,000. That was his thesis, and I never thought of it like that, but he is probably dead right. Next, Michael Saylor was on Fox News with Tucker Carlson. I must say, he cleans up very nice. He got his hair done, new suit, new tie. Well done, Michael. But he had some really cool, eloquent things to say. I think he can deliver the Bitcoin message better than anybody. He said, first of all, Bitcoin is the most secure thing in an unsecure world, number one. And regarding market correlation, Tucker had some very good questions. Michael Saylor said there's no place to hide. All indexes are in bear market territory, no matter what you're in. He spoke about bonds as well. He said bonds are not safe haven as they are currency derivatives. And we all know fiat is debasing. And finally, regarding Bitcoin, I would be buying at the top forever. So he doesn't care. His goal is just anytime he has excess cash, he will deploy into Bitcoin. That's it. And he's a very smart man. But he said a few other things as well, which I thought were interesting. Money supply increased 36% over the last 2 years. And stocks have to grow cash flow faster than the inflation rate. Think about that. That's why I only like stocks with very, very fast growing sales and earnings. He said in that same time frame, gold is up 7%, S&P 500 up 29%, NASDAQ 19%, which is very unusual for tech stocks to be lagging the S&P 500. But that's because they get hit harder. Like I started at the beginning, the highest, most volatile assets fall harder, but they go up faster as well. And Bitcoin is up 229%. So those who are still concerned or freaking out or fearful, this is a good time. Yes, we might go a little bit lower, but the upside is far greater than the downside. That's the message here. So let's talk about gold briefly. This is a cool chart. We are now at the approximately 16.6 level. What that means is the number of ounces of gold per Bitcoin. And this is exactly back at the 2017 peak level where Bitcoin got rejected. Now, typically what happens, sometimes rejection levels, or what they call resistance, can become support. And if you look forward to the right, you will see that this Bitcoin chart is using that same level of support. The question is, will we bounce from here? Odds are highly likely. We saw that yesterday. We saw ETH at the 12-month support levels bouncing around 17,020, 17,030, or no, sorry, 1,730, and it bounced clean. Whew, with big relief, because I was worried if it fell through that, that could be a bad sign. But we're holding, like the dominance is coming down and people are kind of flocking back in. But there's still a lot of bad news out there. So let's talk about a couple of things. One, Bill Miller spoke about Bitcoin versus ETH, and he said the upgrade will leave Bitcoin with one massive advantage over Ethereum. He said proof of stake is one of the big problems that people talk about as a problem, and it's kind of the whole thing about equality, inequality. But basically, with proof of stake, his thesis is rich people can make all the decisions because they'll own the bigger amount of stake. If you have more Ethereum at stake, meaning you own more of it than anybody else, you get whatever you want with the votes, etc., etc. Is that if you own 50% of Berkshire Hathaway stock, you can determine the direction of Berkshire Hathaway. And that's why he thinks Bitcoin has a huge advantage over Ethereum moving to proof of stake. And we'll see. Interesting take as well. You notice Tim Draper, Bill Miller, legends of our time. So listen to these people, watch what they do. Oh, by the way, Bill Miller is still 50-50 Amazon stock Bitcoin. Solana Clock. This is something that has a lot of people worried. It did tank the Solana price a little bit. Slower slot times have caused the Solana blockchain to drift nearly about 30 minutes from the on-chain time. Based on real-world terms, the on-chain time is about 30 minutes behind real-world time. And while it does not affect network operations, it could contribute to some issues around staking rewards. But when we look at the website itself, per the team, the Solana team, they said there's no impact on performance or network operations. They said on-chain timekeeping is running approximately 30 minutes behind the wall clocks due to longer than normal block times. While this has no impact on performance and network operations, the time reported by block explorers and dApps may not reflect wall clock time. Now, the question is, what is the response from the team? So Anatoly was active on Twitter, and in this joyful way, its kind of response is, it may not actually be a bug, but more of a feature. Because he said here, the system clock on Solana is based on proof of history, which is resistant to malicious majority speeding up time. Well, if it's hard for a majority to change it arbitrarily, it's also hard for the majority to keep it precise when proof of history drifts. And that's exactly what's happening. And the question came from John Adler, can it be undrifted without a hard fork? And he said, yeah, it will automatically, I don't know if he was referring to that as well, but he said it will automatically gradually get back to sync once slots drop below 720 milliseconds. And also on the right, he kind of urged his validators to move to the two most recent versions. A lot of people are way, way back and way older versions. And this is a big problem, like 1.9.24, 1.9.23, etc., when the current version is way higher than that. I think it's 1.10.20. So the validators have not been updating their software, which is a problem. So he's urging them to do so, and that'll solve the problem. Now, let's talk about Luna. I don't even want to talk about Luna, but people are asking. There's a free airdrop, and they launched their new, what I call, scam version of Luna. And in the first 24 hours, it's down 75%. A couple of things to note here on this from CoinMarketCap. One, they have self-reported circulating supply. Remember, do not trust any token with self-reported circulating supply. It's a freaking scam, everybody. Be careful. Second of all, look at the originality of 210 million coins as the circulating supply. Just fake. Do Kwon, you are an embarrassment. Go away. This is just shocking that this is allowed to happen. One day, I hope people will fix this type of behavior. In other news, BlockFi slashes rates. A lot of people out there have seen this happen over the past 12 months or so. But BlockFi, back in the old days, pre-summer 2021, they offered about 6.25% for people holding more than one Bitcoin. Now it offers just 1% on people up to 0.35 Bitcoin. So you're not getting any yield there at all. Do not do it. It's not worth the risk. And 0.1% or more on larger amounts. I think they might go as high as 2 or 3% on a third of a Bitcoin, but that's it. So it's not worth the risk. And they also slashed their rates by 50% across all of their assets, Solana, Avalanche, Polygon. So again, not worth the risk. Very simple. Now let's talk about a little bit of macro stuff real quick. Sorry, it's gone on a little later than normal, but there's so much to cover on this Saturday morning. So this is the effects of monetary tightening. Big thank you to Sanjay for sharing this with me this morning. Real interest rates are rising and inflation expectations are falling. So if you look at this chart carefully, you'll see the red line. That's the 5-year nominal bond yield. The yellow is the 5-year real bond yield, which is what you get after inflation. And the green is the 5-year break-even inflation expectations. You'll notice it's just under 3%. And basically, the Fed is getting what it wants. Real interest rates are rising and inflation expectations are falling. And you can see here, it's good. We went through a lot of shocks. We had The Russian invasion of Ukraine shot them to short-term highs, but now expectations are running around 2.9%, and this is high by historical standards, but not far outside the 2.3 to 2.7% range that would be consistent with the Fed's long-term inflation target that we have right now. And remember, keep in mind, these numbers do not reflect current interest rates, but they incorporate expected future interest rates and the stance of monetary policy. So it's good news, the short of that. Now, final piece of fun news. One is why people prefer to work from home. This was a cool study. Again, thank you, Sanjay, for sharing. The reasons employees prefer to work from home: less time commuting, 89% voted for that. Work-life balance, also tied 89% with the less time commuting. More productive working at home, 70% feel they are. Concerns about C19, 56%. And able to live in a different area, 47%. That was interesting. But I think what people really don't realize is the pollution, the stress, the waste of time of long-term commutes. Pre-C19, I knew a ton of people in the Bay Area, and they'd spend 2 hours a day, 2 hours driving in cars. I knew people in LA, 3 hours driving in cars every day. Just think of the pollution and the waste of time and stress and everything else. But at least you can, those who still have to commute can listen to YouTube and get smarter in the process. So with that, everybody, happy weekend. Tomorrow will be live Q&A for those in the US. Happy Memorial Day weekend. Go have a beer, have a barbecue, whatever you need to do. And in the meantime, I'll be here. So I'll see you all tomorrow for us answering your top questions. Thank you all. Bye.